earlier. The first is basically what are your thoughts on the emerging credit issues coming into the CRE sector? Obviously, gotten a lot of attention with New York Community Bank over the course of the last week. New York Community Bank is concerns or issues is a highly idiosyncratic situation, one that I wouldn't draw a lot of parallels to. I think a lot of folks are just assuming are drawing a connection between the current CRE problems, and particularly office CRE problems, and the types of conditions that we saw during the global financial crisis. And I would emphasize that there is a radical difference between those two environments. And the reason why that is first, CRE is on-balance sheet lending. On-balance sheet lending takes time to be recognized. Those losses, those delinquencies and losses take time to be recognized. Those losses only get recognized once there's non-payment and can be extended, modified, adjusted. There's lots of different things banks can do to push out the losses over time. Number two is the nature, the economic exposure that the banks have and the risk that they have is because it's in loans, doesn't have to be marked to market nearly as quickly as what we saw in the global financial crisis. The global financial crisis, those were securities holdings. Those securities holdings had to be marked to market relatively close to fair value relatively quickly. And so you have a situation with CRE that's likely to play out over 10 years, let's say. And even if you had double financial crisis losses in CRE relative to the acute crisis that happened with residential real estate securities, that would be a totally different dynamic for the banks today, because it would give them years of earning power. And in fact, what you did is you went through and you assumed that the CRE losses, the total CRE losses for these banks were double what they were in the Depression, which would be an extraordinarily loss rate, and you gave them 5 years to recognize them, they would earn, for the small banks, they would earn more NIM, more incremental NIM, even if their NIM was cut by 50%, then would be the total loss rate across all of those loans that they have on their books. So what it means is you could have extraordinary losses as long as the banks can push off the losses into history, earn NIM, even depress NIM. They can absorb it without even going into their already relatively elevated regulatory capital. And so the thought, I think a lot of people are looking around and saying, let me find the next crisis and the next crisis. It will not come from CRE. And take that from a person who called the financial crisis right and also called the SVB circumstance not derailing the economy right? They're two totally different circumstances, two totally different times.